This is WPSL Port St. Lucie.
The opinions expressed on this program are those of the program hosts and guests and not necessarily those of this station, management, staff, or sponsors. WPSL does not endorse products that may be mentioned. Any reproduction or retransmission of this broadcast is strictly prohibited without written consent of WPSL.
It's 11:06 at WPSL 1590, the talk of the Treasure Coast. Time now for the world-famous Sun Palm Financial Hour. Good morning, folks. How are you?
Good morning.
Hey, good morning. You're here listening to Sun Palm Financial Broadcast. And like the gentleman mentioned, we are coming to you live here on the Treasure Coast and actually across the world. We're listened to on multiple platforms. You can also hear us on TuneIn if you download the app or go to their website. So first of all, happy Valentine's Day to my co-host, Miss Sandra Liliana.
Thank you. Happy Valentine's Day.
Thank you. So I'm Dee Thomas. My clients call me Dave. I wanted to first recap what we talked about last week on the show, and then we're going to kind of move into the next topic that we're going to be hitting on today. So last week we talked about Social Security. We talked about, is it going to be there essentially when we get to the point of retirement, and is the program in danger? And the conclusion that we reached based on the research from Social Security Administration Board of Trustees was yes, there is definitely a threat to Social Security. They claimed that it would run out, be insolvent essentially in 2034. So in just 10 years. However, the current workforce would be able to cover up to 75 to 80% of those benefits. And we talked about some of the ways that can shore up the program. And while we were in that discussion, there was actually a bill that went forward, which is really great, where they're trying to actually revamp the system. We talked about the different things that they could do to revamp it, but one of the things they were talking about was increasing the dollar amount that could be taxed on your Social Security income. Not the greatest idea, but it was enough when they ran the numbers to not only save the program, but actually make it to where they didn't have to tax the income that came from Social Security. So not a bad idea. It's presently up there in Washington being looked at. And so we'll kind of keep you up to date on that as it is reviewed and continued. So today's topic, we're going to be talking about specifically here on the Treasure Coast and around the United States. We're going to be talking about the cost of living increase and how do we adjust for this? How do we compensate? So we're going to be looking at some different issues and problems. We're going to be focusing more locally, but a lot of these numbers will also be seen throughout the rest of the country for those of you listening around the United States. And of course, everything that happens in the United States, it does tend to have an effect that goes global. So some of these things I'm sure you'll be experiencing internationally for our global audiences. So we're going to be hitting on that subject. But let me first just get a quick discussion here. When we talked about Social Security last week, some of the feedback that we got. So some of the feedback that we got from our viewers, one of them who is a caller, who is Brenda from Port St. Lucie, she mentioned, what about privatizing Social Security? Definitely something that's been talked about and been looked at. We also got some feedback on, some ways that the system could be saved and rehashed. But really, ultimately, the way forward is probably going to be reduce government and fix this border crisis, because a lot of the funds are being borrowed out of the Social Security fund to fund other government programs. And this is something a lot of people were frankly unaware of. So that caught a lot of people off guard, and it should have. So our research on that, I'm glad we were able to, wake some people up on some of the issues that are going on here. Now, before we get started on the next subject, I'm going to kind of read a little disclosure here. Information and opinions contained in the broadcast have been obtained from sources believed to be reliable, and they are given for informational purposes only, and the information is not intended to be used as the sole basis for financial decisions or as a solicitation to sell. I mention that because we're going to be talking about the problems, then we're going to be making some solutions. Each specific situation is individual, and you should always consult with your financial professional before making any decisions. Of course, you can reach out to us here on the Treasure Coast and throughout Florida, and you can reach us at sunpalmfinancial.com. So moving on to the topic here. So cost of living. What's the cost of living increase looking like, and how do we adjust? So right now, there's a few factors that we look at. First is the cost of living when it comes to home ownership or housing. That could be rentals as well. If you're not a homeowner, you might be a renter. The other, and we're going to focus mostly on that, that's the bulk of most people's monthly expense.
So the cost of owning a home, the 4 mortgages every homeowner pays, we call them mortgages because you do end up paying them mostly for the whole time that you have your home, except of course the bank mortgages.
Yep.
A lot of people have a 30-year mortgage. Some of them, a few of them are able to pay way before 30 years, but again, most of them pay them, the whole 30 years. So the 4 mortgages is to the bank, to the utilities company, to the insurance company that we call, of course, homeowners insurance, to the government, which we call, of course, taxes. And sometimes a few people actually have 5 mortgages, which the 5th one is the homeowners association.
Yeah, this is really important, what she just mentioned. It's funny, you never think about it that way, right? We're talking about not just 1 mortgage to the bank. We're talking about essentially 5 mortgages, because as long as you own your home, you're going to be paying these things.
Yeah. Now, some people are not aware of that just because when they actually do an actual loan, and they are able to what is called escrow. What that means is they are able to divide the tax payment into 12 months, their insurance into 12 months, and also their actual mortgage payment. So they pay all 3 things in 1 mortgage payment every month. But again, a lot of people have the escrow in their actual mortgage loan. Some of them don't, but regardless, we all have to pay it.
That would be like the PITI.
Correct. The principal insurance, yes, plus the homeowner's insurance, plus the actual taxes.
That's it. So let's talk about the cost of ownership if it's a second home. What are some of the things to think about there?
Well, it actually doubles everything. Mortgage interest rate is higher on a second home. The taxes are higher because there's no homestead exception. So I know that most people will probably, hopefully know that if there is the primary home, then you do have what is called a homestead exception. That means that their taxes can be reduced because of the fact that they live in that first home. The second home, again, unfortunately, there's no homestead exception. The insurance is higher because it is a rental. The utilities are higher. If it is a short-term rental or long-term rental where the owner pays everything, all the utilities are paid by the landlord, then the renters don't care about things like turning off the lights, or they're not careful to try to reduce that bill.
It's a really great point you just made there. So not only are we talking about the primary home and the cost that's associated with that, but I think the reason why you're mentioning the secondary part of this, which is someone who has a second home, is this affects what? It affects renters, right? Yes. So not everyone owns their own home. A lot of people are renters. And so, of course, the big discussion of the day, especially here in Florida, is just the extreme cost of housing. Affordable housing, we hear about this a lot here in the state. And so where is it coming from? Renters are saying, how am I paying $2,500 and $3,000 a month to live in a 3-bedroom house? Why is that cost? And they think the landlord is just really sticking it to them. But we're going to kind of look at some of these numbers. All right. Now, before I get into this, I want to give you a little bit of background. One of our guests contacted us later and they said, hey, you gave such great information on Social Security. We heard things we'd never heard of before, and your recommendations on investments and such, really, really great stuff. what's your background? So I figured it would be important to kind of introduce ourselves a little more with our background. So Sandra and I both came up in the banking industry. By the time I completed my career in the banking industry, I was working for Fortune 100 banks. Got to the end of my career, I was a vice president for a bank out of Palm Beach, located in Palm Beach, which is in Florida here. And so that was kind of my banking and finance background. And then Sandra also had a similar background, in the banking industry. And then as we shifted into our own business, we started working in the insurance side of things. We found a really great niche in the insurance industry for high volume claim processing and these sort of things. So we spent a lot of time on the risk management side of the insurance before we started Sun Palm Financial, where we look at the investment side of insurance and other aspects. Sandra also worked in her early part of her career in mortgage lending. So some of these topics that we're going to be talking about here are some ways that we can maybe save some money there. We're also professional real estate investors. So we have, actually been in this region and territory for some time. We own some investment properties as well, just full disclosure. So when we talk about these topics, we're not just speaking from something we read, we're talking about things that we have personally experienced and personally advise our clients on. So if you want to, kind of consult with us on some of these things that you hear about, again, you can get on our calendar, sunpalmfinancial.com. All right, so let's talk about how the cost of housing, how these are being affected. So first of all, we were talking about the renters. Why is my rent going up? What does that mean, landlord, doing to me? So she mentioned the cost of a second home, almost everything doubles, right? The mortgage interest rate's higher on a second home, taxes are higher because there's no homestead exemption, and also insurance is higher because it's a rental. And if you have your home as a short-term rental or a furnished rental, you're typically going to be picking up the utilities, which, as Sandra mentioned, that's a mortgage all by itself. We're going to hit more on that later, but it's really gotten out of the park. So all this costs essentially, guess what? It gets passed on to the renter. And it's not necessarily that landlords are being mean. It's that they're just trying to keep their head above water like everybody else. So
Correct.
I'm going to do some numbers, okay? So for instance, let's just do some numbers. If we're talking about the average interest rate on a mortgage, so this is for a landlord who's got a second home. So let's say his monthly payment on the average mortgage right now, and this is for, typical $300,000 3-bedroom house, is somewhere between $1,700 on the low end up to $2,500 per month just for a mortgage. So $2,500 a month, that's $30,000 a year. Then taxes on the average 3-bedroom second home, this is on the Treasure Coast, this is running $500 a month, which is about $6,000 a year. Then you throw in, and by the way, that goes up every year. There's not like a restriction to keep them from really increasing, and they really haven't. Then homeowners insurance. Now we're talking, the numbers are ridiculous now. If it's a second home, of course, you have renters in there. The insurance company really doesn't like you. $9,000 a year. So when we do the numbers, so it's $2,500 for the mortgage. It's $500 for taxes, this is per month, $750 for insurance. That's a total of $3,750 a month for the homeowner. So if they have no mortgage, let's just say they paid off their house before they started renting it, $1,250 would be the lowest. So if you're paying $2,000 a month in rent, your landlord is only making just a few $100s. And not only that, then you throw in if they're paying utilities, if it's in an HOA, if you break something and they have to fix it, or if an appliance goes bad and they have to replace it. So it is at a point now where landlords are really, we're going to make this recommendation later to look at a plan B if you have a second home. And lastly, if you have it as a short-term rental. So right now in the state of Florida, there's a lot of people who have picked up the short-term rentals, right? Vacation rentals. The golden age for those of you who are considering this is over, right? There's so much competition in this sphere. And in this sphere, there's not only a lot of competition, but the state is imposing some heavy taxes, tourism taxes, registration fees, and other, frankly, illegal taxes, as many legal experts are looking at, which exceed 12%. So beyond the taxes and fees and then the competition, most people are finding themselves without a chair when the music stops.
In the long-term rentals, the landlords do not have to pay those fees.
Right. So some legal experts have been looking at some of these details here. And this is in fact, there's a case right now before 4th District Court of Appeals on this very subject. What you have is you have the state imposing tourism and registration and other illegal taxes on the homeowners of a short-term rental that they're not imposing on a long-term renter. Same use, residential, same type of ownership. We're not talking about a corporate ownership. We're talking about individuals renting out their house. However, they're sticking it to the vacation rental people, and they're not giving the same level of taxes and registration and fees on the long-term renters. So the Constitution is pretty clear on this, equal protection. You can't have the same use happening, but you're putting all these fees, registrations, regulations on one side and then not on the other. And not only that, in the state of Florida, back in 2011, there was a law that was passed. Consumers who own short-term rentals were just tired of being regulated by their local city. So they went and they said, hey, state Congress, please pass something to give us protection. And so, in fact, they did. So it's a real simple law. It's like a two-liner, and it basically says that cities cannot regulate these vacation rentals after this date, which was 2011. The only exception is if they had a grandfather clause. So right now, the city of Fort Pierce has been sued because they have been regulating and regulating and regulating everyone, and they don't have a grandfather clause. So this case is before 4th District Court of Appeals right now, and they're looking at this particular case. So those are some pretty interesting things in that sphere of things. Last but not least, we're going to kind of shift on mortgage rates and where they are now and what has been going on with them lately.
So we went to tradingeconomics.com and we found out that the 2.6% in January 2021, that was the record low, jumped to nearly 8% by 2023, which tripled. Now for 2024, it's at 6.7%, so still more than double than in 2021.
That's unbelievable. So we're talking in less than, 2 years. So January, the low, so right at the end of 2020, we're in the twos. The record low was right at January 2021. 2.6 was the interest rate. And now we jumped up to 8%. That is tripled. And where it stands now, as they're finally starting to come down, is where it's 6.7, which is still more than doubled. That's unbelievable. Mm-hmm. How do people compensate for that? I mean, that's a really big, that's a big
Well,
jump.
it's all part of inflation, right?
Well, you would think that right off the bat, right? So obviously the inflation, to offset it, you have to raise interest rates, right? But wow, that's a big number. Has that really become such a need to push it in that direction? Because we're jumping out of one ditch into the other. We'd like to know what you have to say about it. Give us a call, 772-340-1590. That's 772-340-1590. Give us a call. Tell us what you think about it. So so this is some pretty intense stuff going on here. Let's talk about taxes. Now, I'm going to be quoting some research from some others here on this one. Specifically, there was a gentleman, his name's Ryan Arisman. I hope I pronounced your name right, Ryan. FloridaForBoomers.com. He did a really great article. He did a deep dive analysis on the taxes, millage rates, these sorts of things for the Treasure Coast and for the state, really. I've gone behind him, so has Sandra, and we've kind of checked the numbers, and he was dead on. So he kind of talks about what the average millage rate is and how it applies to your taxes and who's, sticking it to you and who isn't, kind of thing, right? So I'm going to quote some of his research. It was really great. So first of all, what is a millage rate? That's the most important question, right? So essentially, the property tax here in Florida is also referred to as a millage rate, and it's expressed in mills per thousand, right? Now, the Florida statewide average property tax rate is at just over 17%. So 17.1 is the millage. Now, what does that mean? What that means, and he uses this example here, what that means is on a house that's assessed at $300,000, your taxes would be around $5,103, and the math works like this: 300 times 17.01333 equals $5,103.99. So what are some of the highest millage rates that we have in the state, and where are they?
So it's San Luis County is the highest in the state at 22.8542.
Wow.
Property taxes on a 300,000 home in San Luis County will run you about $6,856.26, nearly 2 full points above the next highest county.
That's Alachua, 21.30. Wow.
Yeah, which is over 5 points on Miami-Dade, 17.5932, over 10 points above Palm Beach County, 18.7191.
Oh my. Okay, so that's some big numbers. So the state average, 17%, and St. Lucie County millage rate is at almost 23%. So we're talking over 5 points over Miami-Dade and over 10 points over Palm Beach County, and over 2 points of the next highest, which would be Alachua. That's crazy numbers. Why are we so high? That's a really great question.
Well, we actually read TC Palm did a great amount of research. We'll be quoting some of their research. It was regarding that Martin County's budget increased by 6.2% to $559 million compared to 2021 and 2022. This allowed the county to lower the property tax rate by about 3% from 10.27 to 9.96. So it's per 1,000 of taxable property value.
So basically, we're talking about the rate of the taxes. So we're talking about not necessarily millage here, but we're talking about rate.
Correct.
Okay, so they got an increase of $559 million compared to the 2021 and 22 numbers. Okay.
And while tax rate dropped, the budget increased by about 19 million because of increased property values. San Luis County, over the past 12 years, San Luis County's budget has jumped 19% from 592 million to 706 million, while the population has increased by about 27%, or roughly 75,000 people, according to county records.
So essentially, I'm seeing a trend here, and part of the trend that we're starting to see is, and we hear this a lot from our representatives, and I hope they're listening because this is important. When someone looks at you and they say, hey, we've lowered our tax rate, and they have, but we've increased the values, right? We're saving you money. We've lowered it every year for the past couple years. Yeah, but if you increase the values, it definitely offsets any savings that a person would have. And we're actually, you just quoted it, we're actually seeing some numbers. The budget increased in Martin County 19 million because of increased property values. That's some pretty big numbers. How about Indian River? What's going on with Indian River here? Let's see.
Indian River County kept its tax rate unchanged this year after seeing a 13.5% increase in its tax roll, records show. That means about 3.7% increase in property taxes for property owners.
Okay. All right. So basically, Indian River County said, hey, we're not going to change it. But at the same time, because the values went up, 3.7% increase, property taxes still went up for people. Is that kind of the assessment here? So a little bit of a game. The tax rate may drop, but if the values go up, in particular significantly, then there's no savings to the consumer. Now, this is a really big deal. And like I said, I hope our legislators are listening. We have people every day who are leaving the state. And we'll look at some of those numbers in a minute. We have people who are checking out. They're literally, they don't want to live anymore because they can't pay their bills. And in the worst economic crisis, an increase that has record inflation, we're still increasing people's taxes, either through millage, either through rates, or either through values. It's unacceptable. We can't have a tax reprieve, not even 1 year, and not a pretend one or not a bait and switch type of thing, but a real tax reprieve. And so the question might be, well, is it because these municipalities can't afford it? So that was the question that I had. So I'm going to look at some other research TC Palm did on this subject. So I just want to throw out some numbers for you, and it's pretty crazy. So this is as of June 2023. We're now, of course, February 14th, 2024. But TC Palm reported back in June last year, how many homes are being built on the Treasure Coast in the past 5 years? 29,000. That's 5,800 new homes per year. That's 112 new homes per week. And that's a population increase that went from 278,000 to 329,000. This is only up to 2020 before COVID, when everybody moved here after. That was a 51,000 person increase. We're talking about a massive windfall in tax revenue of over the past 5 years, $145 million spread out through the Treasure Coast. Home permits in Port St. Lucie alone, 18,000 home permits. So Port St. Lucie led all the municipalities and unincorporated areas by a long shot, with nearly 18,000 permits issued between 2018 and 2022. According to the records, Fort Pierce, Sebastian issued 1,031 and 1,007 single-family permits over those 5 years. Vero Beach issued 134, Stewart 84. What are we saying? Before we go to the commercial break, what essentially we're saying here is that these tax windfalls from this explosive growth absolutely have given this huge amount of increase to these local budgets. And instead of giving some of that back to the taxpayer in the worst economic crisis, frankly, that we've had in a long time, they're spend. They're saying, well, hey, we have this explosive growth, therefore we need a new police station, or we need more fire services, or we need whatever. And some of that may be true, but there's also some other issues with the growth. New wastewater treatment center is going to have to be built. So there are some other things that are going on. And let's face it, the cost of inflation has also affected these municipalities' ability to do their job. The cost of fuel, for instance, which we'll be talking about later, to drive these police cars around all day, right? And city vehicles. So all these things are kind of being handed off, but we do see a lot of room for reprieve, and we're calling for it, frankly. Go ahead. So what we're going to do now, we're going to go ahead and take a break. And when we come back, we'd like to hear what you think. And if you're a local representative and you want to chime in, 772-340-1590. Love to hear from you.
All right, we'll be back.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, or right now to schedule your free consultation so that you can join the old club. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
This is WPSL Port St. Lucie, the talk of the Treasure Coast.
All right, we're coming back here with the Sun Palm Financial Broadcast, where we talk all things money. And today's topic is the cost of living increases. And I'll tell you, some of the numbers that we've researched, and our local media has also done a deep dive, and some other organizations done a deep dive into some of these topics, is pretty eye-opening. You know, should we be doing all these huge projects in these cities when we have people that can't even pay their rent? We have a lot of, this is Florida, right? So we do have a lot of elderly people who are on a fixed income. And we just talked about an increase that's essentially 300% in some cases within 2 years. So this is something that we would normally, see stretched out over a 20-year period or whatever. How can anyone compensate for that? So we talked about the issue with the taxes going up. And so now we're going to kind of shift to the insurance component of the housing situation. This is a real deal hot button item. Sandra, tell us about it.
So we actually did research and found a Yahoo Finance report. According to the Insurance Information Institute, Florida insurance premiums have gone up by 300% in the last 5 years.
Wow.
The average cost of home insurance in the United States is $1,700, whereas Floridians pay over $4,200 annually if they can get insurance at all. Insurance companies cover their potential losses by purchasing something that is called reinsurance, which is an insurance policy that insurance companies buy to protect themselves in the event of a natural disaster. Now, the cost of recent hurricane claims has caused reinsurance rates to spike, and that has led to an unprecedented rise in home insurance premiums for Florida home and business owners. Worse yet, it's causing many insurance carriers to leave the state entirely.
Yep.
Since 2017, 4 major hurricanes have hit Florida, 3 of those being Category 4 or 5, causing a destruction that has cost the insurance companies billions. The U.S. Census Bureau shows that nearly 276,000 people left Florida in 2022, and it is believed that skyrocketing insurance premiums motivated many of the departures.
Wow. So this is some really important stuff here. So we're talking about the cost of insurance. It has gone up 300% in the last 5 years, essentially.
Mm-hmm.
And everyone has seen this, right? So we're talking about, and the crazy part is it's actually in our legislation that they can't just increase it, 30% this year, 20% next year, 40%, that there's a certain threshold. However, they have to approach our legislature to get that approval if they want to go above that. And correct me if I'm wrong, but they continue to just approve these increases carte blanche, don't they?
Correct. But I do also want to make sure that people understand that homeowners insurance is required if you actually have a loan. If you own your home upright, you don't actually have to have homeowners insurance. Now, of course, we wouldn't recommend that just because we do live in Florida and it's very likely to get hurricanes every year, and sometimes even more than one. But I just want to make sure that people understand that that is a requirement of the mortgage companies, of the banks, not really that it's actually a requirement of the state or anything like that. Again, if you own your home, you're not required to have it. Now, a lot of people that own their home, they actually have the discipline to put money aside per month to where if anything would happen, any type of damage from a hurricane, they would be able to pay it. But again, that takes a lot of discipline.
So self-insuring.
Yes, it's self-insurance, correct.
That's a really great point that not a lot of people ever talk about. So let's talk about it for a minute. All right. So let's say $10,000 a year is what your insurance bill is, right? So think about it, listeners. When was the last time you had a claim? And how much did it cost, right? So if you were to, and just think about it, if you're to take that $10,000 and religiously put it aside, invest it with us, in 5 years, you've got how much? $50,000 in principal plus whatever interest you've gained. That would cover any major problem, roof replacement or whatever for the average home. 7 years, we're talking about $70,000.
You figure our last claim was 2005.
Think about it.
Wilma.
That's right. Think about it. So, that's definitely something to consider if you're willing to take that risk. Especially right now, there's so many lawsuits going against these insurance companies because frankly, they're just not paying. There's so many fine lines written in your policy that they may not cover things that people are really starting to say, this makes more sense. You also talked about, go ahead. Yeah.
Well, I also wanted to let people know those that actually have a mortgage on their home, and again, because they have a mortgage, the bank does require to have insurance. Keep in mind to try to understand your homeowner insurance policy before a hurricane comes, because a lot of people don't understand that they have to pay a deductible. So the deductible is the first part of the actual claim that is paid by you, the homeowner. Okay, and then anything above the deductible, according to the actual policy, if you do have coverage, then the insurance company will put any amount again above the deductible.
And the deductible has almost doubled in the last 5 years.
Yeah, in some cases. So usually your deductible on a homeowner's insurance policy is going to be either 2% of the value, 5% of the value. That's a lot of money. So if you're picking the cheaper policy, it's probably going to have the 5%. So that means you're going to have to eat 5% of the value of your property before insurance even kicks in.
Yes,
So-
and where you would find that is on what is called the declaration page of your homeowner's insurance. You will see what is called different coverages. So coverage A is your dwelling.
Yep.
So that would be the amount that would actually cover to repair your home. Now, there's another one, the second one, that is actually other structures. That's anything besides your dwelling, as an example, a fence or a shed or anything like that. So just make sure that you actually review your declaration page on your homeowner's insurance before you actually get a hurricane.
Right, and just so everyone knows, Sandra and I are both licensed here in the state of Florida as adjusters, so we're not just talking about information that we don't know about. So
Yeah, we've been doing it for over 9 years.
yeah, so we have that license, and that was part of our area of specialization for one of the companies we had. So definitely some food for thought there. Now, as we kind of look at some of the other things, you talked about insurance companies leaving the state. I think we all remember, and I won't mention the name of the insurance carrier, but we had this huge amount of money that the governor set aside, and he said, hey, we're going to put this big bunch of money aside to cover these claims or any legal fees that are going to be associated with these claims, with Ian in particular, and that way it will have an effect on the rates. Well, what did this large insurance carrier do? They took the money or whatever, I guess, and left the state. So, it drives us crazy that these are some of the things that you should, as a legislator, you should look into. What could this insurance company do? Should you have some catch-alls to protect the taxpayer or whatever? And so this is some of the things that we're starting to see. So definitely a big situation here with the insurance companies. I'm going to make a recommendation. Being in that industry for some time, the thing our legislatures need to do when they go up there, and the insurance companies are going to pull their hair out when I say this, essentially what needs to happen is they need to be legislated into keeping more of their reserves, bottom line, to pay claims. Good, for instance, 2004, 2005, that there were 4 or 5 hurricanes that hit all at once, right? But my friends, we didn't have a major hurricane from that time frame all the way up until 2017. We're talking, there was Matthew jumped in there, I think
in 2005, if I'm not mistaken, we did have
that's what I'm saying.
That's when, yeah.
Yep. So from 2005 up until around 2017,
Correct.
there were no major storms. That is an incredible sum of money to have collected from these insurance companies. That should have been, a portion of that should have been set aside for reserve for a rainy day. And the rainy day did come. We have had a few storms that have come through back to back to back. But why is it that we're having to eat those costs when it was their bad decision and how much they should set aside? Well, they didn't want to set aside a lot in reserves. They want to go ahead and invest the money, spend the money, and expand and whatever. And then when the going gets tough, they get out of the state. Unacceptable. We need to have some look at all these things. So as we're kind of moving towards the second part here, if you have any input you'd like to give us, 772-340-1590. When we come back from the break here, we're going to be talking about some ways to offset some of these costs. But before we go to the break, I'm just going to hit on a couple other things, right? Utilities. Because of the cost of fuel and some of these other factors, you know, if we're talking about plants that are being run off of natural gas or some of these other things, doubled. Utilities have doubled. HOA fees. This is something that people don't talk a lot about. HOA fees, of course, continue to rise. And we've seen cases out of Miami where the HOA literally stole the money and that people have been charged and are looking at prison time over this. So HOAs, you definitely, there's some challenges there. Cost of fuel tripled. We were at $1.89 in 2020. We're now, as of today, $3.35 average here in Florida in the Treasure Coast area. So when the cost of fuel triples, the cost of everything else triples. That's including food. Okay, so now tractors cost more money to run, delivery trucks cost more money to bring the food. So we're talking about the food costs have tripled. But there's one thing that hasn't doubled, one thing that hasn't tripled, and there's one thing that hasn't changed at all, according to our research, in 15 years at least, and that's salaries. That's a tough one. Salaries have not increased on the Treasure Coast in 15 years, despite the fact that everything else is doubled, tripled, and who knows where it's going to go next. All right, so we're going to head to the break, and then we'll come back from the gloom and doom. We're going to make some great recommendations.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, or right now to schedule your free consultation so that you can join the old club. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
This is WPSL Port St. Lucie, the talk of the Treasure Coast.
And welcome back to the Sun Palm Financial broadcast. We're here coming at you live from the Treasure Coast and around the world. And right now we're talking about cost of living increases. How do we compensate for them? We've looked at how ridiculous the costs have gone up in just the past couple of years, and there's just doesn't seem to be any end in sight at this point. And the one thing that hasn't gone up is salaries and pay. It seems like it's pretty much been stagnant. Now there is an increase in the minimum wage and these kinds of things, but really it's not having a big effect on meeting these challenges and needs. So we're going to come up with some recommendations in our last 10 minutes or so of the broadcast that we think that you could do based on your specific financial situation. If you're a low, moderate income, whether you're in that category, middle class, if you want to call it, or the upper crust, if you want to call it, our old money people. So here's a couple recommendations. So the first one is, and some of you may already be implementing these, but I'll share them with you anyway. First one, consolidate households and combine incomes. We're starting to see a lot of people do this. We're having multiple generations living in the same house. So by having this shared costs It's going to be a little crowded, might be a little frustrating, but moving back into mom's basement is not a bad idea at this point, especially if you're a young person or a young couple. You might get some help from the grandparents for the kids and so on, and combining incomes, or if they're kind enough, they let you stay in the house and bank all of your money so that you can go ahead and move out a couple years down the road, when things kind of get better or when you have enough money. So
Also, you might want to think young people coming out of high school to go to a local college. If you actually go to the financial aid offices, a lot of colleges at this time, they will actually give some type of programs, like incentives for you to stay locally. So you might want to think about that, such as like Indian River State College, other colleges like that you might want to actually find out about programs.
great point. So in the Treasure Coast, Indian River State College had, I don't know if they still do, definitely want to talk to them about this, and your local advisor at your high school. They had some really great programs where you could go into Indian River State College, get your AA or some, and then continue on after that. But even if there's no programs, you're saving that housing cost as a parent when you let them go to the local college. And I'm going to tell you, I've been out there, full disclosure, one of our children actually decided to go into their engineering program. Fantastic school. I really can't say enough about them.
Yeah, and that is called the Promise Program.
Yep.
Now in year 3, it was just launched again on the
Okay.
24th of January.
This is Greg
So-
Wyatt, our engineer. He's telling
Yeah.
us. some
Well, the
info.
president of the college was here last week. So,
Awesome. Tell us,
and
Greg.
he was talking about that, and they're very proud of that.
Great.
And it's any student in all 4 counties that they serve. If you have a C average or better,
Wonderful.
you're in.
That's great.
Awesome.
Fantastic. So let's
There you
talk
go.
about, if you're in the higher economic bracket, what are some things you can do? Well, let's just shoot you straight. If you've got that big house and all the kids have moved out, or you're on the water and you've got these outlandish insurance costs, or you live in a really high HOA, this might be the time to downsize, right? Now, the truth is, if you live on the water or live in a really high HOA, downsizing may not be less house. You can actually sell where you are and get the same size house just without that extra HOA, without that extra insurance cost, without that extra tax. So something to think about. The other ideas or some things to think about: reverse mortgage. I don't recommend that you do a reverse mortgage if you have children that you want to leave your home to, right?
You might want to explain what reverse mortgage is.
Yeah, so essentially reverse mortgages, if I own my home, I can actually use the equity in it and get a reverse mortgage, and it pays me for however long I'm going to be alive, essentially. And then at the end, I think they get the house is kind of how that works.
The bank does, yeah. So
Correct.
that's why the word reverse comes from. So it's actually the opposite of when you're purchasing it from the bank, you're paying the bank. Reverse is that you already own your property, and then the bank is paying you. But of course, at the end, the bank owns the home. Now they do have different programs. You would have to find out how, more about that, how it works. But either way, it's something that if you have not been able to actually plan for retirement, that could help you.
Yeah. Another thing you can consider, we had some folks that bought their house at this high end of the rates, which was almost 8%. It's now dropped to 6.5%. There are predictions it will drop even lower by the end of the year. Consider a refinance. But when we talk about refinance, there's some things to factor in. You want to look at low or no cost refis.
Correct.
Yeah.
Because if not, then you will actually be paying what is called a closing cost.
And origination
And
maybe.
origination as well. Well, actual origination will be more when you're purchasing it, but either way, you might actually be charged that as well. You actually have to find out what fees would you be paying for, and then there are other options where you can actually put it into the loan. But keep in mind, if you do that, then you would actually be paying that amount, with your mortgage, meaning in the time frame of your mortgage. So if it's a 30 years, sometimes it's going to cost you like $5,000, $6,000 to close. You might be actually paying in the long run much more than that.
Right. There's something called a break-even point. You want to have your loan officer do a calculation for the break-even point to make sure that it makes sense. I'm going to kind of go through these other ones pretty quickly here based on the time. So this one's a big one. Second home. it does not make sense to have a second home anymore in this time frame.
At this
The
time.
amount of money you're making is minimal. The amount of work is probably a fortune. There's a lot of competition in this space, and there's a lot of people desperate to move into a house. Doesn't make sense. Right now you have an opportunity, if you have a second home, sell. Why? Because now we have the values have really gone up after 2020. So you're gonna, if you sell that house, you're making a lot more than you would have just 2 years ago. And the rates for investments are much higher now. I can take those funds that you have there, sell your house, drop it in an investment account, maybe in an annuity for 6.5% for the rest of your life. So not in the stock market. I'm talking about an annuity, guaranteed. You don't have to threaten your principal, so you don't have to be a landlord anymore. So definitely a huge opportunity there. Come see us at sunpalmfinancial.com if you want to talk about that more. So pick up an extra job. That's another recommendation. Move out of state. If you're in the low to moderate income range and you're in a service job type of situation, I would look at potentially talking to some relatives or friends in, Alabama, Georgia, Tennessee, North Carolina. Quality of living is high. Cost of living is much lower. So we've got a couple other recommendations. Build wealth through life insurance, index universal life. You can be your own bank. So you can take these savings that we're talking about, start putting it into an investment account. You can be your own bank. You can borrow against it. And of course, the largest way to pass on money to the next generation is through life insurance, right? Some other ones that you can see here. So rent out a room, but be very careful. You don't want to just have anybody in there. And I like this one, garage sale. You have thousands of dollars worth of stuff in your garage if you'll sell it. Look at remote jobs. Also, maybe negotiate with your cable company or drop cable and go to streaming. You can also renegotiate your escrow if your loan to value is low enough. You can also look at your car insurance, contact some other companies. You can save several $100s doing that. And of course, one of my favorites, cable companies or internet companies. If you're paying $150 to $200 a month and there's a promo with another company, go with the other company or use that to renegotiate your rate. When you add up all these savings, we're talking about thousands of dollars a year. These are some of the ways that we can recommend. And last but not least, we're in the greatest state in the country where everyone comes to vacation, staycation. There's so many awesome things to do here. Instead of spending money on airline tickets to go overseas to be at the beach, enjoy your local community and help out your local businesses. And last but not least, my favorite, vote. We didn't get here by accident. There's a distinct time frame that we were talking about in here that's very evident. Don't want to get into politics, but the truth is when you see such a change and a shift, voting has consequences. So that's our recommendations today. Hope you enjoyed the show. And coming up next week, we're going to be hitting on some other topics. We hope you'll tune in to WPSL Radio AM at 1590.
And where do we find you folks? On the web and phone number?
Yeah, so you can reach out to us. I'll just give you the website. It is real simple. It's sunpalmfinancial.com. And our phone number's listed there, email's listed there. You can get on our calendar, just pick an available date. We'd love to talk to you about some of these things, investments, retirement, and income strategies.
All right. Have a good week.
Have a good
Happy Valentine's Day.